listeners. This is your weekly FX commentary brought to you by Rare ECN. So this week commentary, we will explore and highlight the pound-dollar market. This week is packed for a market-moving risk event out from the US as well as the UK, especially the UK, as last week's GDP number failed to trigger a positive response as investors look forward to Tuesday's CPI print and MPC minutes for more insight on the next Bank of England monetary policy move. This commentary will largely be broken into two components. There are a technical aspect and a fundamental front. So firstly, we will break down and explore the technical front on the pound-dollar market. The narrative on the pound-US dollar price action last week has been tainted by volatility. Nevertheless, the pair managed to establish a short-term bottom during Friday trading session. The RSI reading on the pound appeared to be positively diverging into bullish territory. Currently, the pair is trading between the boundary of 23.6% retracement marked by the 1.67392 level, while the support tier is set up at 38.2% expansion at 1.66757. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, retail traders continue to favor piling onto long pound-dollar position with current long to short interest sitting at a ratio of 2 to 1. So analysis of a collection of technical indicators on the hourly time interval of the pound-dollar cross is suggestive of a temporary bullish market sentiment and recommend short positions on the greenback. The pound-dollar pair opened today's Sydney trading session midway between the established resistance at 1.6756 while the support is set at 1.6670. The pair continued to trade below the 200-day simple moving average, which allowed the market to revise the long-term outlook on the cross to bearish if it continued to hold below the 200-day simple moving average. The significance of the 200 days cannot be underestimated, as 200 days contain more or less of 1 year's worth of trading data. This bearish sentiment is not validated on the short-term moving average front, as the pair opened today's Sydney trading session above the 5, 10, 20, and 30-day simple moving average, which is indicative of a buy recommendation on short-term moving average front. So moving along to the fundamental component of this pound-dollar market. Last week, Bank of England inflation report and its dovish rhetoric has certainly done its part in undermining the market's confidence on its UK interest rate expectation. This fracture in investors' confidence and sentiment towards the pound sterling was translated into last week's dramatic sell-off in the pound-dollar pair. Nevertheless, the trading week slowly approaches last Friday. The UK quarterly GDP print failed to induce a significant rebounds in the pound. The UK GDP year-on-year print came in better than expectation by ticking in at 3.2%, beating a growth forecast of a 3.1% expansion. In addition to that, the UK GDP quarter-on-quarter came in line with expectation at 0.8%. However, this was not enough to give the pound a buying momentum. This GDP report showed that it is the highest pace of economic expansion since 2007. What this implies is that the UK economy has continued to outperform its G7 counterparts. Since last week's Bank of England inflation report, with Mark Carney reiterated to the market that the next key component in the bank's mandate is wage growth, this recent GDP continued to have a muted effect on monetary policy expectation. As recent Bank of England commentary indicates that the bank will less likely to raise the rate anytime before the first quarter of 2015. Over the last 6 weeks, the price action on the pound-dollar market clearly shows six consecutive weeks of decline in the pound, leaving many analysts in favor of a near-term technical rebound. However, the catalyst for a near-term bounce is subjected to this week's risk opportunities. Starting off this week's risk event is Tuesday UK CPI month-on-month print forecast to contract by 0.2%, while the CPI year-on-year is expected to come in at 1.8%. UK PPI import is expected to contract by 1%, while on Wednesday the market can anticipate the UK MPC minutes release, followed by Thursday UK core retail sale month-on-month expected to come in at 0.4%, while UK retail sale month-on-month is forecast to grow by 0.4%. Over in the United States, last Friday trading session saw the 10-year Treasury yield declining to 2.31% on geopolitical tension sparked by a report that the Ukrainian military has shut down several Russian convoys. This has kept the greenback supported on safe haven demand despite a weaker than expected Tier 2 leading economic report out from the US. And according to the Michigan Consumer Sentiment, US consumer confidence has fallen to 9 months low, coupled with a decline in manufacturing activity in the New York area. Heading into this week's trading session, the US have several risk opportunities, starting off with Tuesday US building permits forecast to come in at 1 million, while the US building permit month-on-month is expected to tick in at 2.5%. In addition to that, the US CPI year-on-year is expected to come in at 1.9%, while the US core CPI month-on-month is forecast to read at 0.2%. Also, CPI month-on-month is expected to expand by 0.1%. On Wednesday, the FOMC meeting will take place, followed by Thursday, US existing home sale month-on-month forecast to come in at 5.02 million, while the Philadelphia Fed Manufacturing Index is expected to read at 20. Wrapping up this week's trading session is Friday Fed Chairman Janet Yellen testimony. Thank you everybody for listening, and have a successful trading session, everyone.